Everyone, today I'll be introducing Mr. Wessner, Managing Director at Cantor Fitzgerald. In this role, he has had a wealth of experience spending over a decade heading the capital markets division. He has overseen more than $6.5 billion of commercial real estate debt and equity transactions, as well as purchasing-led acquisitions of more than $2 billion across various asset types. Prior to Cantor Fitzgerald, he co-founded Park Bridge Financial, where he provided distressed debt and equity solutions. He also has experience at Merrill Lynch, Fitch Ratings, and Ernst & Young. He received his Bachelor's of Arts from the University of Miami and his MBA from the University of Florida. Let's give a very warm welcome to Mr. Wessner.
Well, thank you so much. You guys all hear me? Perfect, thank you. It's great to be back on campus. So I graduated from the business school here in 2001. So 23 years ago now, and I don't come back as often as I would like, and hopefully this is the start of me coming back more frequently. And I love spending time with students, and the university, gave a lot to me, and I feel fortunate to be able to stand in front of you and hopefully give something back to you. It's real important to me, and so thank you for having me. The commercial real estate market, there's a lot going on right now. I would love for this to be a lively discussion. As I tell my colleagues, feedback is so important. I want to make sure, I'm getting something from you, you're getting something from me. Please interrupt me, and let's just have a lively discussion on what I think is a very, very interesting time in the commercial real estate market. Like all markets go through cycles. This is a really interesting cycle. And for those of you that are graduating and looking for jobs in the next, short bit here, you may say to yourself, oh my God, the market's so soft and there's a lot This is a great time to start a career because there's really only one way to go, up. So that feels like a good time to start. So quick agenda, quick introduction. I was asked to kind of give a little bit of my backstory, kind of like how I ended up from where you sit to where I'm standing, a little bit of my backstory, and happy to talk a little bit about that. Just real estate investment fundamentals. Everyone in this room is incredibly smart, and your faculty is incredibly smart, but I think it's just important to sometimes take a step back, and let's just use $100, as I wrote up on the board here, to talk about a deal. Forget about millions and commas and spreadsheets. Let's just talk about $100. And I think over time, a lot of my colleagues have gotten a lot out of that. And then a general market discussion. There's a lot to talk about in the debt and equity capital markets right now across the country. And then something I really, got a lot out of when I was a student was, textbooks and classes are fantastic, but let's talk about deals, right? Real deals, live deals, deals I've done personally, deals that are in the market currently, to kind of give you a sense of where are the real estate capital markets literally at this moment. Kind of a view from the trenches, if you will. I thought you guys would get something out of that. So a little something about me. Picture's worth 1,000 words, right? So from left to right, I grew up in Miami. Love Miami, been gone a long time now. I tell my now every February and January when we're chipping ice off the cars, aren't we supposed to move back to Florida? And every year she says no, because she's a Jersey girl, and Jersey girls don't leave New Jersey. But that's fine. I knew that going in, and we love New Jersey. So left to right, I grew up in Miami, but now I work in New York. Our offices are on 59th and Park in Midtown Manhattan, and I did move from Gainesville. I moved onto 56th Street in Manhattan, and now I live in New Jersey with my wife and daughter. So how did I go from left to right? Well, I went to Palmetto High School down in Miami. I don't know if any of you are from Miami, maybe recognize the name, public high school. We have a couple famous alumni. Jeff Bezos of Amazon went to my high school. I say to myself, our high school diplomas look the same, but our lives are a little bit different. And then most recently, Ketanji Jackson, the Supreme Court Justice. She went to my high school, actually the same year as me. And my wife asked me when she was nominated to the Supreme Court, she said, oh, same year. Did you know, Ketanji? And I was like, different classes. We didn't know each other. So I went to high school. Then I went to University of Miami. Don't throw anything at me, did go to University of Miami. And the reason I put that mascot picture there in the middle of the U is that was actually me. I was the mascot for 2 years. So I have worn orange spandex in front of 70,000 people. and yellow feet. I'm a proud bird, and that was a great time. And it's funny, even to this day, I've been working in real estate in New York for 23 years now. A lot of people know that story, and when I go to dinners and whatnot, sometimes people 20 years later will say, "Are you that guy that was the mascot?" So it's such a silly story, but it's followed me in yellow feet for many years. So how did I get, and then of course, here in Gainesville for my business degree. But along the way, how did I even get started in this business? And I put a picture on the left there of a guy on a ladder painting an apartment. That is not me, but that's how I started in this business. So when I was in high school in Miami, we had a family friend who owned a small portfolio, about 20 apartment units and a little strip center. And just as, family friend, and he would hire me to paint apartments when tenants would leave and cut the grass, getting my hands dirty. That's how I learned the business, again, in high school. And over the years, as his portfolio grew and he trusted me, I started leasing. I started evicting. I had power of attorney. I was signing documents on his behalf and started running that little portfolio to where, when I graduated from Miami, he gave me one of his apartments. I lived there for free. I would rent out the second bedroom to my friends. Now I was running a little real estate business. My grandmother had a house in Miami, which was empty, and she was a very shrewd businesswoman. I paid the mortgage and gave her a little extra profit and rented out the bedrooms to my friends at a profit. Now I was actually making money off my friends. They knew it, and it was fine. And that's how I learned the real estate business, hands-on. And thinking back, it was a great way to learn because even to this day, again, we're going to talk about $100. The deals I'm doing now on average are 100 million. But the fundamentals are exactly the same. It's exactly the same. I think that's an important concept. So then I had to get a job. So I started working at Arthur Andersen. We'll talk about, I worked at Arthur Andersen twice. Once after undergrad, and then after graduating from UF, I returned to Arthur Andersen in structured products, in a product called CMBS, you may have heard of, Commercial Mortgage-Backed Securities. So I started in CMBS at Arthur Andersen in 2001 after leaving here. And that was when that market was just getting going, right? And by the way, in every career, everyone in this room is smart and is going to get a great job. But sometimes you got to get lucky. And I got lucky. I was in this new product called CMBS. And it turned into what it did. It was huge. And I was able to ride the wave. And so I started at Arthur Andersen. I was tying out deals. I'm not a CPA, far from it. But I was on the consulting side, the advisory side, helping. My clients were Goldman Sachs, Bear Stearns, gone, Lehman Brothers, gone, Deutsche Bank, Credit Suisse, and Merrill Lynch. So those were my clients. And it was a great way to learn the structured finance business. And it was great. Summer of 2001, for those of you that may remember, that's when Enron was happening. Arthur Andersen goes bankrupt. So now I just moved to New York, only been there a few months, potentially out of a job. The good news is CMBS is hot. People are hiring. Went over to Ernst & Young. Our entire group, there might have been 30 of us. We just went from Andersen to Ernst & Young. It was very quick. The partners just moved us over. Got lucky. Lucky number 2. Sometimes you got to get lucky. And then was at E&Y. So my whole accounting side of my background lasted about 3 years on the accounting side, serving those types of clients. I then went to one of my clients. I think it was a long time ago, it was Deutsche Bank. And I'll never forget. I went to this senior guy, this managing director, who's my boss at the time on the client side. And I said, "Good news, Steve," or whatever his name was, I forgot. I said, "I want to work for you." And he goes, "Oh, Aaron, you seem like a nice guy, and pretty smart, I don't know." He goes, "But I'm not going to hire you." And I was upset. I was like, I wanted my Wall Street investment banking job. And the guy that I thought was going to hire me said no. And he said, "Here's why I'm not going to hire you. Because you're great at working until midnight, making sure 2 + 2 = 4, but you have no idea how we make money." I was like, well, that's probably true. So he goes, "I'm going to give you some advice. Go work at a rating agency where you learn the arbitrage of CMBS, which is taking, again, small numbers. You take $100 in loans, you put it through this process called securitization, you may have heard of, and you create $103 in bonds. You make 3% out of the air. It's an arbitrage. He goes, go work at Fitch, and they'll teach you the arbitrage of how to make money in structured products. Great. He made the phone call, got me my job at Fitch. Now I'm at Fitch. I worked at Fitch for 3 years. It's a pretty normal progression. Then you either stay at Fitch because it's a very comfortable 9-to-5 job. It's fine. I still have friends that have been there for 20 years. But I always wanted that banking job. I always wanted to be a principal. And then that's when I moved over to Merrill Lynch. So that was my first banking job. I was on the securitization team at Merrill Lynch. At this point in my career, I'm a vice president level, mid-level person running CMBS deals. So just plain vanilla CMBS deals. At the time, they were about $1 billion, about 100 loans. You take 100 loans, you turn it into bonds, and you do it as fast as you can. So Merrill Lynch gave us capital. You could run a CMBS business with about $500 or $600 million, and you're turning it as fast as you can. And so I was on the sell side. So our loan originators would make loans. Me and my team, we would package those loans and sell them as bonds. So traditional Wall Street investment banking on the structured product side. Loved it. Then that was from 06 to 09, great financial crisis. All of us lose our jobs. Not just Merrill Lynch. Bear Stearns, bankrupt. Lehman Brothers, gone. Everybody, the whole street, everyone's out of a job. It was great while it lasted, but now everyone's out of a job. Luckily, just given where I was within the firm, I was part of the sell side again, to where I had to I was part of the team that cleaned up the mess. So, we had, hundreds of loans on our books that we had to get rid of now, all at a loss. We're losing money. And so having seen that 20 years ago now, almost 20 years ago now, having cleaned up a mess when the music stops, and we're going to talk about that, I think really made me a better real estate professional, because when times are good, right, it's just momentum. It's when times are bad that you really learn. And so that was a great experience. But now I'm out of a job. One thing I met with some students before this, and the one piece of career advice I would give all of you is guard your reputation with your life. I know it sounds like a parent would say that or whatnot, but it really is true. At the peak, we had 100 people working in our CMBS business at Merrill. I was one of the last 5. They liked me. They trusted me. I had a good reputation. And when we finally shut the lights off at those last 5, my boss took me to Parkbridge Financial to found the company. It's a boutique advisory firm, still in business. You can go to their website. And, I was fortunate. Someone gave me a lifeline. I got lucky again. Luck number 3. Somebody like me took me under their wing as a mid-level, vice president level person. And, hey, I want to start a company, and I want you to help me start this company. And it was great. Parkbridge Financial, and David, his name is, he's still there. Wonderful guy. We still talk. But I wanted to get back to the principal side, just for who I am, my career. I like giving people money, whether it's as a loan or as an equity investor. And so I've always sort of had a principal mindset. And that's when Cantor Fitzgerald, one of my friends who was a trader at Bear Stearns, also out of a job, got a job at Cantor Fitzgerald as a startup, CMBS 2.0. Now I have my job at Cantor Fitzgerald. We built up our CMBS business. So I think we lent, $15 billion. We made $15 billion of loans. And that was my start at Cantor. I think I was the 30th employee at Cantor Fitzgerald on the real estate side. And now across our family of businesses, we have a few thousand employees in real estate. It was great. So at Cantor, and then I'll go on to the deal, enough about me, into deals. Cantor's been great. We started as a lender, again, CMBS lender. We then acquired, three-legged stool, started as a lender. That business has since been shut down. Not a good time. Over the past few years, we prefer to put that capital into equity deals versus debt. Started as a lender. Now we're a principal private equity firm to high net worth families. That's our primary investor base. We then acquired a real estate firm you may be familiar with called Newmark. Does that name ring a bell? So Newmark is our sister company. That really is our secret weapon in the real estate business. And how it fits together is Cantor Fitzgerald owns all of the controlling shares of Newmark. And so our chairman, Howard Lutnick, is also the chairman of Newmark. We control it. Public company, public shareholders, but we control it. And so we refer to Newmark as we. I talk to my Newmark colleagues across the country every day. And then the third leg of the stool is the current business I'm involved in, which is our private equity business. We raise money from investors and we deploy that capital. And so, and we'll talk about our portfolio in a minute. And that's my journey. And I appreciate, being able to tell my story. Not everyone's heard it. Happy to answer any quick questions before we move on and how I got from palm trees to the concrete jungle. But it's been great. And the story's not over. I've been at Cantor 13 years, and Cantor's a very entrepreneurial firm. I would love to finish my career there, but you never know. You never know. But it really is, they've been great to me over the past 13 years. Any questions on maybe just from here to there? Yes?
So is Newmark kind of like a feeder for some of the investments?
Absolutely. So Newmark, again, is a big brokerage firm, thousands of brokers across the country. There's two things when you're doing deals. You need money and you need deals. The good news is Newmark just gives us a steady flow of deals. But at the same time, if it's a sale, if they're selling a property and I might want to buy it, their duty is to the seller. They can't kind of show us off-market deals like sweetheart deals. Their duty is to the seller. But often we get an early look or a last look or what have you. It's been and the sellers love that because they know that we'll execute. And so it's deal flow and it's also information. The real estate business, I mentioned this to the students earlier, the real estate business is an old-fashioned business. It's a relationship business, and different investors can have different information, right? And so that's how you can also create arbitrages. I might know something you don't. I might be willing to pay $1 million more because I know something that you don't. Or I might say, if I'm the number 2 bidder, and the broker wants me to push a little further to win that deal, I might know something that hurts the deal, and I back away. And we've seen that. And so really, it's our competitive advantage in many ways is through information. And information is worth its gold. When you're making investment decisions, those with the best information win.
Where's the line between the information between you and Newmark? Like, Newmark tells you, or the broker says, like, hey, I wouldn't do this deal because X, or like, you should look at X, Y, Z.
It's just information. I mean, again, it's not something that there's no material non-public information. It's just information. Hey, do you think about this? Or hey, the property. I've been in Dallas for 20 years. You may want to consider this neighborhood, not that neighborhood. Just information. Nothing nothing that runs afoul of any rules.
What is the foul? Like, where would that lie?
I would say any sort of non-public material information is always the line. Any other questions before we move on? Well, thank you for letting me tell my story. So again, a little bit about Cantor, founded in 1945, so we're almost 80 years old. We've only had 2 CEOs in that entire time, Bernie Cantor and his young protege, back his first job out of college, who's our current boss, Howard Lutnick. So in 80 years, only 2 CEOs. And our current chairman, Howard, has been with the firm for 40 years. It was his first job out of college, 40 years. We have 12,000 employees across the country. I would say half of that is Newmark, because again, they're our sister firm. 12,000 employees, across the globe. New York is our headquarters, where I sit. Our second largest office is in London. We're in 22 countries, but again, globally, really Europe is where we have some real strength. We have an investment grade credit rating, so we have a strong balance sheet, which again allows us to transact in size and in nimbleness with certainty. We have access to capital, right? That's the holy grail. We have access to capital. And just to kind of give you a sense of who we are in terms of the capital markets, we're a primary dealer of U.S. Treasuries, right? So we deal directly with the U.S. Federal Reserve. Why is that interesting? There's only 24 of them in the whole country. Goldman Sachs, Morgan Stanley, household names you're familiar with, including a firm like ours. So to be part of that peer group, we feel is pretty neat. And again, it just gives us more information. Where are interest rates? Where are they today? Where are they going? Who are the buyers? Again, information is really the currency of any financial services business. And then we talked about Newmark. Trades on the NASDAQ. There's the ticker. Over $100 billion in transaction in 22. The last time it was more of a normal market. That number, of course, is lower as of last year. Oh, it did freeze. You told me this was going to happen. Happened early.
Aaron, did you say that Europe is where more of your business is?
No, U.S. for sure. Our second largest hub is Europe. Any questions while we're waiting for this to reload on just maybe now before we get into market discussion? Yes.
You said you began work in like 2001, like summertime. How did like 9/11 affect that since it was so close after?
Yeah, it's a great question. So it was a very interesting time. So my roommate worked in the World Trade Center, where the first plane flew in, and luckily he was on a business trip that day. He lost all of his colleagues, and what really resonates with me, and I can remember this is way before cell phones, right? And I can remember my mom calling me. It happened at 8:30 in the morning. It was a Tuesday morning. It was a day like today, just a gorgeous day, a bright blue sky. And I can remember my mom calling me and saying, "You okay? You okay?" in that panic voice. And I said, "Yeah, I'm sitting on my desk." And she goes, "You don't know what's going on?" I said, "No, there was no TVs, no cell phones." She told me what happened. I went outside. We worked on 6th Avenue, and you can, if you know New York, you can look straight down 6th Avenue and see downtown, the World Trade Center. And I saw, what was happening, and of course everyone goes home. And I can remember that night. Finally, my roommate called at in the evening, and I was like, "Hey, Pat, have you called your parents? Because they're calling us." So, just a shocking time. Luckily, nothing happened to me and anyone I knew closely. I knew some people who died, but they were more acquaintances. It was hard. And in our firm, as you may know, as you may have heard, Cantor Fitzgerald was headquartered at the top of the World Trade Center. So the plane went in on the 86th floor. Our firm was headquartered on the 102nd floor, so nobody could get out. And when the buildings fell down, so we were the firm that day, and Howard, you can Google it. He's on, was on the TV, of course. We lost 658 people that day. The company that lost the most. And very dark day in our history, but at the same time, we celebrate it every year on 9/11. It's our annual charity day. All of our firm's revenues go to, originally it was the families, but that was a long time ago. Now it's charities around the world. I think last I checked, we had raised over the past 20 years, I think $200 million that we've given away to charity. And very well supported by celebrities. It's kind of neat when you have former presidents walking. It's interesting. And again, we celebrate it. It's a sad day, but we celebrate it. And you have the A-list to the C-list in the same room. So I can remember talking to President Clinton, and behind me, the Real Housewives of New Jersey are on the phone in the same room. A lot of athletes, the Manning brothers, and so anyway. So our firm has been very well supported by celebrities to raise that money, and we still do it every 9/11. So, okay, so a little bit about Cantor Fitzgerald. We have beyond just real estate, our asset management business, and there's our website, just cantorassetmanagement.com. Up on the upper left, those two top boxes is what we're going to discuss today, just real assets and tax advantage strategies. But we also do have some mutual funds, just typical long-only stock funds. We have cash management projects, et cetera. But the bulk of our business is real estate. This is our current portfolio. We've raised $3 billion of equity over the past 8 years. Again, all high net worth. I'll get to your question in a second. All high net worth with leverage. We have a $5 billion portfolio, so $5 billion of real estate value, 12,000 apartments across the country, and about 8 million square feet or so of commercial space. These are assets we own to kind of give you a sense of the type of stuff that we own. And then we've raised, on the left there, we've done 51 private equity offerings.
My question was just about the government securities. I was just curious, a little bit more detail about that, specifically what they are and how you guys got that,
That mandate, yeah. So as a primary dealer, when the U.S. government issues treasuries, right? Just think the plain vanilla is a 10-year treasury, right? So when the U.S. government issues treasuries, they don't go to the end buyer first, right? They go through a broker-dealer. We're a broker-dealer. So we have to guarantee that we'll buy 500 million of it. And so we take down 500, and then we pass it on to the end user. So we act as a broker-dealer to facilitate the issuance of U.S. treasuries. So this is our portfolio. And then part of our business is development. And we'll talk about that in a minute. Most of what we do is stabilized real estate, properties that are generating cash flow, right? Rents, cash flow, income. But one part of our business is opportunity zones, which you may be familiar with. It's these sort of underserved areas that are in need of capital to develop. It's actually one of the larger pieces of our business. We've raised over $900 million of equity in the opportunity zone business across the country. And these are some of the projects that we're developing right now. On the left, that's Astra Tower in Salt Lake City. It's the tallest building in the state of Utah. It's going to be luxury apartments. I was out there recently touring the property. We're at the top floor now. And I told our leasing person, I said, what is it, the Utah Jazz, the basketball team out there? I said, the rents that we want in this building, this is going to be the nicest building in Salt Lake City. Start talking to the NBA players, because that's what we're going to need in this building. And so I think we'll get some NBA players living in here. It is spectacular, with the mountains in the background, Park City, Utah, right? So it is spectacular. But it's a big bet. That's a big property. The one in the middle, that is South Pier in Tempe Town Lake. So that's an opportunity zone adjacent to Arizona State University. So we're building 3 towers there, 700 units. That picture at the top with the 3 cranes, that was probably a few weeks ago. So these properties are out of the ground, and we're building. And then the one on the right, that's Apex at Meadows in Las Vegas. The picture on the top, that's the Strip in the distance. So we're probably 5 or so miles north of the Strip. That property's done. The picture on the bottom is a real picture. That's what it looks like today. So we're leasing it up. Rents here are probably $1,800 a month on average, and we're about 30% leased. So to kind of give you a sense of, we go from stabilized assets all the way to development. So real estate fundamentals. I just think it's very important to sometimes take a breath. And everyone, again, I know I'm repeating myself, everyone here is smart. Everyone here knows how to use Excel and run a spreadsheet. But, I think a lot of people, when they think about real estate and finance, they think about spreadsheets and models and numbers and, data. You got to start with what's on the left. People in a room. Why are these people, when I come across people asking us for money, why are you asking? Are you buying something? Are you refinancing something? You trying to solve a problem? You trying to push your problem on me? Like, this apartment building you're selling, why? Like, are you selling it because it's a piece of junk and you don't want it? So you have to understand and take a breath and put the numbers aside and just ask yourself why. Why is this person even sitting across from me? Why are they asking me for money? And I think that's really important. And, I was with some of your professors earlier this morning, and, one thing that when we're looking to hire people, again, everyone that comes across my office is smart and they can run a spreadsheet. What I always ask them is, can you think? Just think. We don't hire people that say yes, because then you have the risk of what's called groupthink, right? Everyone's in a room, you're about to make an investment decisions, lots of zeros, lots of risk, and if everyone just says yes, 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 you might do a bad deal. I want to go around the room, even with young people, I want someone to put their hand up and say, did we think about this? Or I was looking at that spreadsheet and 2 + 2 = 4, but I think it should probably be 5. So I just want to make sure before we get into numbers and live deals that you understand the importance of taking a breath and just thinking. Forget about the numbers. Forget it. If the deal makes sense, you then look at the numbers. I just think that's really important. I guess the analogy or the corollary would be like doctors. What is it called when, like, the surgeons are in the operating room? They have the knife. They're about to amputate a leg. They do a timeout. Is it the left or the right? Right? What is it? Ask twice, cut once. So it's no different as an investor. As soon as you push the button when you send the wire, your money's not coming back. I'll never forget one of my first big deals at Cantor. This was early in our business when our chairman was very involved day to day. Now he's not as involved day to day. And my boss was running late or something was happening. We were closing on a deal. I'll never forget, it was one of our first $100 million deals, pretty big deal. And I was asked to go downstairs. Maybe I'm at the firm 4 or 5 years at this time. Hey, Howard's downstairs. We need him to sign off on the wire. Hey, Aaron, would you mind going down there and just getting his signature? Which, okay. So I knew the deal. I knew it cold. Every number on the closing statement, I knew every number. And I walked into his office, and I had the closing statement, and I slid it across his desk, and he's in, his giant office. Beautiful artwork on the wall, marble everywhere, something out of a movie, out of a TV show. And I slid the thing across. I'm walking through the numbers. He's not even looking at it. He's looking directly, not in my eyes, he's looking behind me, through me to the wall behind me. And I'm walking through every single number. And I get to the bottom, and I said, Howard, we're ready to close. And he pauses. The glasses go to the tip of his nose, and he goes, you good? Never looked at the numbers. He was looking for fear. Was I confident? I said, yeah, we're ready to close. He goes, okay. Send the wire, $100 million. So I just want to make sure that, again, someone like that, the chairman of a company, he trusts his people, number one, but he also wants to make sure that we thought it through. He just assumes that we know the numbers. He just wanted to know if at the last moment, could we walk away from the deal? We could have. We would have lost our deposit. But it's better to be wrong. This is a great Wall Street line that you'll learn. It's better to be wrong than long. It's better to lose a $5 million deposit than to make a $100 million bad investment. It's better to be wrong than long. So market discussion. Before we get into the market, anything? I'm sorry. Wrong than long?
Love that quote.
So let's just talk, before we get into this market discussion, let's just talk about, I'm sorry, on this side, if you can't see, and this is the only color we had here. Actually, there were some other darker ones. But again, before we get into markets, let's just make sure we understand just the basics. This is elementary school. This is way below you guys in this great program. But let's just make sure we're all on the same page. You buy a property for $100. That's the price. You guys know what cap rates are, right? Capitalization rate, that's the valuation multiple. You buy it at a 6 cap, okay? That's gonna generate $6 a year, right? In cash flow, 6 cap. You get a loan for $70. You pay 4% on the loan, right? This is what's called positive leverage, right? That's the real estate business. Other people's money. It's a levered equity business. $100, $6 a year. $70 at 4%, which is what? $2.80. You now have $30 of equity at risk, equity in the deal, but you now have levered your equity to where you're earning a 10% cash on cash return. Does that make sense? I mean, that is the real estate game. A 10% cash on cash. In this example, you buy at a 6, finance at a 4, you generate a 10. Basic, levered equity. Then, of course, real estate has incredible tax benefits, right? Depreciation, expenses, what have you. Most of this equity return, $30 times 10%, that's what, $3 a year? That $3 a year, almost all of it stays in your pocket. You don't have to pay taxes on that income because it's sheltered by these depreciation, property management fees, paint, carpet, what have you, just expenses. Such that the tax equivalent return is a 15. Because if you had put this same $30 and just bought, put it into a savings account earning 5%, what have you, you have to pay tax on the 5%. It's income. Where real estate is very tax efficient. So before we get into the market discussion, I just wanted to make sure that we understood just the raw basics of why the real estate business has been so successful over decades for people. Are we all on the same page? The basics, $100. Okay. And by the way, so where are we today? Let's just kind of update this real quick. Why is there so much stress in the market as we go into this slide here? Because now, let's just assume cap rates are the same at 6%, but now your financing costs are 7 or above 7, as I know we have some lenders in this room. Now, Instead of generating a 10, now you have negative leverage. Now you bought, now the bank is making more than the equity. So now your return, instead of being a 10, is a 4. You see my point? You're actually diluting your returns. Where here, you're levering your returns, going from 6 to 10. Here, you're going from 6 to 4. This is called negative leverage. That's not the real estate business. The system is broken, which is why we see all this on the news. I just want to make sure, I think if there's something you take away from today, I really want to make sure you understand just the basics. Does that make sense before we move on? Okay. So this is what's on TV these days and in the papers, right? CNBC and Bloomberg and the Wall Street Journal and et cetera, et cetera. Distress, scary, throwing the keys back. There's just a lot of noise in the real estate business right now. How do we get here? Fact versus hype. But in every choppy market, there's always opportunities. There's always opportunities. So let's discuss. So we're not going to go through all these numbers, but I just wanted to make sure you understood sort of how we got here. So again, we're not going to go through all the numbers, but let's just look at the top. Let's just assume this is an apartment deal. See the price, PX, that's sort of old way of saying price. That's how traders price bonds, PX. So PX is price, $24 million deal. You got a 70% loan, so that's 16.8. So you had $7.2 million of equity, right, in the deal. That's the check. Your equity in the deal, and then you're going to spend $1 million to renovate the apartments, then sell it. That's the plan. We're going to buy in year 1, sell in year 4. So we're going to buy these apartments for $24 million in the yellow, and 4 years later, we're going to sell them for 30, right? And we're going to do it with 70%, with $16 million from a bank or from a CMBS shop or whatever. It doesn't matter where it comes from, all right? So then EGI is effective gross income and then expenses. So $2 million in income, $1 million in expenses. You have NOI of $1 million, net operating income, right? NOI. So this thing throws off $1 million a year, $1 million a year in income. You're then going to have to, then you borrowed the money, the $16.8 million. The bank at this time in 2021, you could get money. Money was free, near zero. The bank takes a profit. The bank charges you 3%. So now your CFADS is cash flow after debt service. So the million goes to 496,000, and now your cash on cash return, you see COC, is almost a 7. So you bought $24 million is a 4% cap rate. Instead of 6, this is 4. And you lever your equity to now you're generating a 7. You hold this thing for 4 years, and you sell for $30 million, and when you do the IRR analysis, that's a 27 IRR. That seems great. That looks like a hedge fund. This looks like I'm buying a vacation house in 2 Porsches, not just 1. I'm buying 2. And so this is how real estate syndicators, you may have heard that term, real estate syndicators would run around and raise equity. And they would tell people, why would you want to put your money in a savings account earning 2% when I can show you this flashy real estate deal where you could buy Porsches and boats, and we're going to make a 27% return. And that's how so much money, people were just opening their wallets. This is like, oh, this is great. This is Wall Street. This is sexy. This is real estate. This is great. This is a hedge fund, hedge fund-like returns. It's real estate safe. Here's what actually happened. 2024. There's what's called a pro forma. You've heard that term, right? Looking into your crystal ball. Last I checked, crystal balls get a little cloudy. Here's what actually happened. You paid $24 million, right? That is, again, back to my example. Once the money leaves the door, you're long. You could be right or wrong, but now the money's gone. Now you own this piece of property, whether you like it or not. You paid $24 million. Again, the cap rate doesn't change. Your cash flow, everything is the same. But you don't get the rent growth you thought. You see at the top the EGI growth. Rents were growing very fast in the country. 10% growth, 7% growth. We're just going to keep raising people's rents. People are just going to pay more every single month. And we're going to take this cash flow from $1 million to $1.4 million in 4 years, and then cap it at a 475, and that's $30 million of value. Here's what actually happened. Expenses, rent growth was slower. It was 5%, 3%, and then nothing this year. Expenses went through the roof. You may have heard about the insurance problem here in Florida. May ring a bell. Your expenses ran against you, and cap rates blew out. You thought you were going to sell this at a 475. Now you only have the same $1 million of cash flow, and cap rates have blown out. You bought the property for $24 million, and you sold it for 17. You took a loss. And by the way, the 8.2, that is, that's your equity at risk. That's your equity. So you put out 8.2, and you got back 950 grand. This group lost $7 million. That's a negative 46% IRR. No Porsches, no beach houses, and you're out of a job. This is the market we're in right now. And if you look at the loan value here, the loan hasn't changed. You still owe the bank, on the left, 16.8. That's debt. You got to pay it back. The property's only worth 17.5. Now the bank is starting to send you emails. Get me out of this thing. Banks are not in the business of losing money. So how do we get out? So now the bank's going to give you a new loan. You can either sell this at 17.8 and just lick your wounds and your reputation and figure it out, take a loss. Or you can try and refinance and buy time. Refinance, buy time. But if you refinance right now, and we don't have to go into these details, but at 65% leverage instead of 70%, now you can only get a $10 million loan. Well, I owe the bank 16. That's when you call someone like us. And we give you the $6 million, but our price is 15%. So we'll save you. It's just not going to be cheap.
How much involvement in management of the property would Cantor have in that?
Yeah, so we have local property managers. I mean, we're in charge, and they execute our plan, but we're very involved with its decision making. We're not.
If you want the money, here's the plan that you have to abide by in order to.
So in this example, we're going to go into, this will be what's called rescue capital. You know, when we're looking at rescue capital deals, I was looking at one today. You know, investment decision. You know, are we willing to put money into this asset at this level, at this price? If this was an office building, we may say, we have no bid, no price. Sorry, it didn't work out. So does that kind of make sense? Yes.
Looking at it from like more of an investment perspective, something that stands out is like underwriting rent growth over the expense growth at that dramatic of a level.
The market was hot.
Like you guys wouldn't, if you guys were going to invest in a deal, wouldn't y'all keep your rent growth and your expense growth like relatively similar?
Yeah.
So you just push time all the way on it?
Again, I don't want to cast aspersions on people. A lot of money was raised this way. This was just a very aggressive underwriting. It was a frothy market. We tend to underwrite the historical average for apartments over like 30 years is 3%. So when we underwrite deals, it's 3% on the expense side, the revenue growth side, and now we're underwriting 4 to 5 on the expense side. It used to be 3 and 3. Now we keep the 3, but with inflation, we bump up the expense side. So we take a more conservative approach. I'm not saying we're the best underwriters in the world because it just is, the market is what it is. In 2021, that was the market. And a lot of money was raised, and a lot of people did a lot of deals. So how did we get here? What happened? This goes back, I wanted to use a chart which sort of described back to sort of my journey, back to 2001 when I left Gainesville. This is the Fed funds rate and the average 30-year mortgage, which is the really choppy line, over 20 plus years. And so you can see the vertical shaded areas are recessions. And so since I've been out of school, there's been 3 recessions. This is the tech bubble and 9/11. This is the great financial crisis. You can see how long that lasted. The red line again is where the Federal Reserve was moving interest rates to try and fix the mess, took interest rates to 0 for a very long period of time to get out of the great financial crisis. I mean, look at how long that was. And then as the economy was just red hot They started raising interest rates. Excuse me. Then you have COVID, a dramatic black swan event. They take interest rates back to zero. But it wasn't enough to offset all of this free money. There was already an asset bubble. Now, look at how steep and how dramatic the increase in interest rates was. You know, if that line, and you can see this is the highest now in 20 years, if that line on the right had a shallower slope, you could kind of work your way through it. But when interest rates go from 0 to 5, so a 500% increase in like a year and a half, you just take the car and just slam on the brakes. We didn't do a deal for a year. When that was happening, we slammed on the brakes. We didn't buy a property for a year because the valuations weren't right. So I just think, and then the jagged line is mortgages. And so, you know, the average American cannot afford a 7% mortgage because, you know, my friends, when they bought their house, when they refinanced their mortgages after COVID at 3%, they locked in 2 and 3% for 30 years. So that's another reason why you're not seeing any sort of new houses come on the market, because people can't afford to sell. I mean, hope you like your house. So this is it in a nutshell. I hope this makes sense. I mean, it's so dramatic, and it happened very quickly. Forget about the noise here, but this is just the LIBOR curve. And so again, the same thing is just you can see where LIBOR is, and this is floating rate loans. It's the same thing. Look at how dramatic LIBOR shot up. And so back in 2021, the example, well, this example here that we just did, 2021, look at where interest rates were. 0. Money was free. And so people were borrowing as much as they could. Now, when these loans have to be refinanced, look at how high the interest rate shot up. That's what's causing all the pain in the market. So some stats, we're not going to go through every number here, but you know, this is all from Newmark, our sister company. All of this is available to you on their website. They really do a good job with research. So again, when I graduated, so this is CMBS for the most part. This is CMBS, all real estate debt, but directionally CMBS as well. This is when I was lucky enough to get my job in CMBS, this new product, and I rode this wave up until I got laid off here, and then rode it up again. And then here we are now. So the market is just much larger, but you can see the cycles. You can see the cycles. And then the number of lenders. The number of lenders has also dramatically declined. From peak to trough, you can see 29% less lenders. There are 1,700, lenders in America during the peak of the market, and not just banks, debt funds, et cetera, alternative lenders. Now it's, there's 500 fewer lenders. That's pulling capital out of the system. It's hard to borrow right now. So as banks spend the next several years cleaning up their balance sheets, this is a significant supply shock to the real estate ecosystem, in the sense that, back to my original example, the real estate business is a levered equity business. You need debt. Real estate survives on debt. So where are the opportunities? Where are the opportunities? This is where we're looking at today. We have capital, we want to invest it. What is happening here? So in the face of all of this, of these dramatically higher rates, at the same time, it sounds cliche to say perfect storm, but at the same time, there's $900 billion in loans coming due this year. 900 billion. Next year, 573. And then you see, so $2 trillion of debt is coming due in the next 3 years. $2 trillion. We've never seen a wave like this because all of these loans, most commercial real estate loans are 5 years or 10 years, and they're all maturing at the same time in a higher interest rate environment, which is causing significant stress. So there's the mountain. This is called the maturity mountain. And then here's the current interest rate environment. Straight up. Office and multifamily remain in focus. They're just giant asset classes. So you can see here this was last year, this is this year. The blue is multifamily and office are the biggest chunks. those are the largest asset classes in the commercial real estate space. 29% of those loans were originated during the bubble, when money was free. Almost 30% were originated during the bubble, and they're all coming due. So if you're a borrower, you have that 2% mortgage, you now have to refinance at 7%, and you don't have a choice. Because if you can't, the lender's going to take your property. And so a lot of times on TV, or if you're talking to your professors or other industry professionals that may be in front of you, they're going to say, well, the Fed's going to cut rates, right? The Fed's going to cut rates. Just hold on. Survive until 25. We hear that a lot. Survive until 25. Well, interest rates aren't going back to zero. This is the forward curve. You can see interest rates are projected to drop, but they're not going back down here. Interest rates in the 4 to 5% range are very normal. That's a healthy market. And so if you borrowed at 1% and you're going to 4%, you still have a 400% increase. It's creating significant stress. Some loans will be able to absorb the higher interest costs, but many will not. Just focusing on multifamily and industrial, two hot asset classes. The dark blue here is high-risk loans. Loans that have what's called a DSCR coverage, is debt service coverage ratio. Less than 1.25, this is sort of the minimum. You want a 25% cushion. Our research indicates that 54 billion of apartment deals are now have coverages less than that, $54 billion. And you say to yourself, oh, but apartments are the best asset class. Why are they so stressed? Because that's where lenders would push. Because it's perceived as it is a safer asset class, so lenders would push a little deeper into the stack. So historically, how did you make money in the real estate business? You would borrow $70. You would increase the value of the property. Let's just say you doubled the value. You go from $100 of value to $200 of value. You would then get a new loan, right? You go back to your lender and say, good news, I want to refinance, my property's worth more. Give me the same 70%, right? This is 70%. Give me the same 70%. 70% of 140, of 200, is 140. Well, you only owe the bank 70. Where's that other $70 go? Porsches and beach houses in your pocket. So now you had $30 of equity at risk. You just put $70 in your pocket. You're playing with the house's money. That's the real estate game. And by the way, just to this point, historically, you would do that's called a cash out refi. Cash out. You're getting a new loan and you're pulling cash out of the deal. Today, when we go through the deal examples, property owners have to put cash in. It's literally the opposite. So according to our research, $1.3 trillion of debt is in trouble. 1.3 trillion, and this stat has been floated around CNBC and other networks by many of my colleagues. This is our research, and of that trillion, about half of it is maturing over the next 3 years. So if you have fresh capital, if you understand the preferred equity in high yield real estate business, there's a significant amount of opportunity to generate outsized high yield returns. Banks, debt funds, and CMBS face the greatest challenges. They're the biggest lenders, and they also sort of stretch the furthest. So, these are the banks in focus. You may remember last spring, 2 major banks failed, right? There was Silicon Valley Bank and Signature Bank. Newmark actually was the firm that sold that debt, so we got that mandate from the FDIC. I forget what price it sold at. It was a structured trade. That debt did clear the market. But you did see bank failures, and you will see more.
If you could put this in perspective to the entire economy, how big of an impact can a lot of these going sour have in relation to the entire economy potentially collapsing or getting hurt real bad?
So starting on the equity side, there are many property owners that are going to lose it all. From the lending side, there will be a significant number of bank failures. There's debt funds that are going to fail. Debt funds are also levered. It's Debt funds, where do debt funds get the $70? It's loan on loan. Of that $70, they're borrowing 50. So they have a lender. It's loan on loan. And so when all of this debt, comes crashing down, you're going to see significant. And by the way, I heard a great quote recently. If you owe a bank $1 million, you're sort of the one in the risk position. If you owe the bank $100 million, they're in the risk position. It could blow up the bank. And so, as you're looking at deals, again, forget about the spreadsheets. I really want to emphasize that. Forget about the spreadsheets. Just think about the psychology of the deal. If you're staring at a bank that has a big loan that's going bad, in many cases, the borrower has more leverage than the lender because that big loan could blow up the bank. So the lender might be willing to take that phone call to save that person's job and save the bank. And so that is a very important part of the negotiation. Who has the leverage in the negotiation?
So why did the bank put themselves in that position in the first place?
I mean, they had $30 of equity cushion, a $70 loan on a $100 property. That was pretty common. And it just went bad. So what sort of leading indicators? We're always looking for leading indicators, trying to take the fog out of that crystal ball. Do you guys know what mezzanine debt is? Does that ring a bell? Mezz debt? It's like the middle. So mezz foreclosures have to be publicly announced. You can see the spike in mezz foreclosure announcements. It's already happening. So quickly so that was debt capital markets. Any questions on the debt capital markets before we move on to the equity capital markets? Yes.
How is this going to impact our deal with our employer right now?
Employers?
Yes.
So how about this? We're going to talk about jobs at the end, but the punchline is if you work for a bank, if you were an originator, right, doing deals, giving people money, going to dinners and doing that whole thing, you don't do that anymore. You're on the other side of the office, working out problems. And so people are just changing their day-to-day job function to try and hold on, survive until 25 if they can. If you're a consulting firm, a real estate consulting firm like my old employer, you're very busy because their borrowers are calling you saying, help, get me out of this. So if you're a consultant right now, you're very busy. If you're a private equity firm, you're probably trying to figure out what to tell your investors because you're going to take losses.
You talk about debt funds being a little bit more risky, so to speak.
Mm-hmm.
I know a lot of companies are starting to bolster up their debt funds, chasing yields.
Mm-hmm.
So when it comes to these maturities and working out loans, how do these debt funds kind of navigate through this?
Yeah, it's a great question. Here we go, debt funds, the gray. So the debt funds, pretty small. It's this darker gray. It's this pretty small piece of the overall market. Those debt funds, those funds could take some losses. Hopefully their reputations are good enough that they'll just say, we didn't do anything wrong. It was just the market, we got caught. But this next vintage, give me fresh capital. Fresh capital right now, to what you're hearing is, and we're doing the same thing, it is a great time to be a lender. A great time because rates are high and capital is scarce. We're putting out, again, we'll talk about pricing in a minute, but on the debt side, our interest rates start at 10% and we're turning deals away. Okay, so the equity capital markets, just a little bit shorter section, but just similar themes. So transaction volume. I know we have some folks in here that are in the transaction business. Down significantly. You can see coming out of the great financial crisis, everyone's doing deals, right? Everyone's doing deals. And then it just falls off a cliff as interest rates start to rise. There are no safe harbors. Every transaction, every asset class, has been affected. There are no safe harbors. Multifamily down 61%. Industrial, which is like a darling, right? Amazon buildings down almost 50%. Retail down, office down, hotels down. Across the board, there was no safe harbor. Investor allocation, sort of like what's the desired asset class? Where's capital flowing? You can see multifamily, how popular this got. This is over time, starting in 2007, ending in, this is 23. You can see apartment investors, the allocation to apartments peaked at 41% and then starting to go lower. You can see industrial. Industrial is the only one that has an upward trend. Industrial has been very, very hot, right? E-commerce driving industrial. Great asset class. Look at office. Before the great financial crisis, investors were allocating 31% of every dollar to office. Now it's 13%. What do you think that does to office valuations? Retail kind of bumps around the same level. Hospitality has always been a bit of a niche asset class. Others like self-storage, data centers, that kind of thing. Sales volume sharply down across just everywhere. We talked about that. There's no safe harbors. Major markets are down. Secondary markets are down. And tertiary is rural. Down, down, down. And by region. You can't say that, oh, well, if I invested in the South, capital is still going to flow to the Southeast. Florida, Texas, down, 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 down. Across the board, the market is choppy right now. Again, some top markets, and just the dots represent drops in sales volume. Everything down, down. Look at Seattle, 72% drop year over year. If you're a broker in Seattle, I don't know what you're doing. I think your golf game is in really good shape. But where are the opportunities, right? Where are the opportunities? Everyone is chasing apartments, right? And we're going to talk about apartments. It's our preferred asset class. Apartments are fantastic for all the reasons we know. People need a place to live. 7% mortgages, people can't afford that. There's more. Our portfolio is on average 92%, 93% occupied. The apartments are full. So money is going toward apartments. But where's money not going? It's not going to office, and it's not going to retail, but it doesn't mean that you can paint those classes with a broad brush. There are diamonds in the rough. Me and my team, we're in the office 4 days a week. Some weeks 5. New York City is alive. People that tell you that office is dead are wrong. And we're going to talk about jobs here at the end. And I would encourage you, when you guys get into the workforce, don't look for a reason to stay home. Remote work will kill your careers. Get in the room. Be in the room. It sounds simplistic, whether it's sitting at your desk or whether it's going to that client dinner or what have you, be in the room. The people that advance in their careers are in the room. It sounds simple, but it's very true. That dinner with all of those senior people, get to that table. Don't say I'm working from home. So cap rates, and I think this is the last one, yeah. So cap rates. And by the way, the dotted lines I've used throughout here, don't think the orange and blue was by accident. So I did that last night. Had to be Gator colors. So cap rates. So this is, again, going back to when I graduated, summer of 2001. You guys, again, know where cap rates are, right? When cap rates go down, prices go up. So when this line, you see this line going down, down, down for 14 years, 13 years, that means asset prices are going higher and higher and higher, right? So this is the first time, if you look at the great financial crisis right here, here's the GFC, you'll see the dotted, forget about the really jagged line, that's corporate bonds, which are a proxy to real estate. Just look at the colored lines. Less volatility because real estate's illiquid. Bonds are liquid. Bonds have a lot of what's called beta. Beta is the volatility, alpha is change in value. A lot of beta in bonds, less beta in real estate. So if you look at the blue lines, they're just the general trajectory. The only time they've ever gone up, when cap rates go up, prices go down. So the only time real estate lost value was the great financial crisis, and now. So it's been 13 years since we've seen real estate values drop. It's been a great investment.
Why do you think it was so long between the two periods of the cycle that typically happen much sooner?
Money was free.
Do you think the Fed should have hiked much sooner to curb enthusiasm for the real estate market? Or do you think all those underwriting, all those aggressive practices, which side do you think, is it somewhere in the middle?
I had had fun during that time. I mean, I'm not a central banker. I never want to be. No, it was just, I think, euphoria. Look, the GFC was nasty. I mean, that was a bad one, and it took a long time to fix it, just to clean all of that, those derivatives, the CDOs and everything you guys are aware of, out of the system. It took a long time.
So when Silicon Valley Bank failed and some of the other turmoil that happened earlier in the year, it seemed like the regulators and the central banks were really aware of the amount of stress that was being put on the banks.
Mm-hmm.
I'm just kind of curious about how much communication goes on between the government and a lot of these parties, because it seems like how dramatically the interest rates went up are kind of pushing these firms like very close to the breaking point, very close to the edges of their like sensitivity analysis.
Mm-hmm.
It's kind of hard for me to imagine that after the great financial crisis, they're like, because they had time where they could have been slowly raising rates. So I'm just curious on your thoughts there.
It's a mystery, and there could be some political, pressures in there. Politicians like when things are good. So again, bank regulators, I think, are wearing some of the blame, but they're regulators. More banks will fail? Absolutely. Though absolutely, we are, part of our investment strategy right now is we are looking, I don't know that we'll buy a bank. I don't think we'll buy a bank, but we'll buy the loans off their balance sheet.
You say there's a lot of decrease in transaction. You find it, they just gonna, investor are gonna move the capital to something else.
Mhm.
It's just holding right now to wait for everything to go.
I think we're buying. So we just did 2 deals in the past 6 months. We did a $100 million deal in Dallas and a $100 million deal in Westchester County, New York City area. So we're buying. We're starting to see it's loosening up. It's still not anywhere like it was, but you're starting to see buyers and sellers come together. And I'll tell you something else that is never in charts. You know what's not in all these charts? People's careers. If you're a deal guy, if you're a deal person, guy or gal, if you're a deal person and you have equity, you have capital, you're a fund, you're a private equity fund, someone gave you, $1 billion to invest, you know what you're going to do with it? You're going to sort of hold your nose, shut your eyes, and you're going to try and find a good deal. You're going to invest it. Private equity firms like us, we don't give the money back. If we get it, invest it. We're going to do it prudently. But I think you're starting to see deals come together and people try and really look under rocks to find deals for also career survival. Because at some point, people are going to be out of jobs. So deal people do deals.
Is that the reason why the capital that you're holding right now and the asset you're holding, that the ratio is like 60%?
We have a lot of dry powder because we still think there's more opportunities later this year than right now. It depends on, we have different buckets of capital, we can get into that. But for our high yield capital, we think the opportunity is right now.
Yeah, so what category of banks do you expect to see failing? I think the consensus is smaller banks, but I'm curious if you have any insight.
Yeah, I don't think it's the local banks. The local banks really know their borrowers. I mean, that's a relationship business, and there's a banker here. I think it's regional banks. Regional banks are the ones that have always been the most aggressive.
Since you started to get back in the market, have you seen that bid-ask spread start to compress?
Absolutely. So, like I said, let's talk about real deals. The deal we did in Dallas, we bought at a 5.66 cap rate. That same deal 2 years ago was 4.5. The deal we did in New York City was 6.15, north of New York, 6.15. A little older property, 20 years old. So let's talk about deals, and then we'll talk about jobs, and I think we're right on time. So this is a deal that my team and I bought in 2018. This was our first ever apartment deal. So we bought this deal in Norterra Canyon Apartments in Vegas. So that was a good site inspection. Had to go to Vegas a few times. Which, by the way, as you guys go into the real estate business, you gotta kick the tires. So I hope you guys like to travel. And if you do, it's a great way to just see the country and on your employer's dime. And usually there's deal making happening. So it's great dinners, it's great trips, it's a lot of fun. But again, never do it casually. When you're investing capital, it's a deadly serious business. But you can have a lot of fun doing it. So Las Vegas, you guys may be familiar with Vegas. The Strip is sort of right there in the middle. This was North Las Vegas. Our investment thesis here was that highway where the VA Medical Center is at the very top, that highway was just completed in like 2015. And we bought this a few years later. So this northern Las Vegas area was all the development was going that direction. So we tried to get ahead of it and buying this little older property. This property was built in 2007. We bought it for $59, almost $60 million, which was a 5.63 cap rate. And again, 2018, good level. Here's our debt. We financed it at 4.55. So usually the spread, right? We talked about this. Excuse me. We talked about positive leverage, 6 to 4. In this case, it was 6 to 4.5. Pretty close. So positive leverage. This was a straight down the middle of the fairway deal. We bought it for $140,000 per unit. Now, like I said, in your career, you got to get lucky. We got lucky. So interest rates come crashing down, and you can see where our cap rate came in almost 100 basis points. So 3 years later, we sold this property for $86.5 million. In 3 years, we made, what is that difference? We made $25 million in 3 years. It was a great return for our investors. It was great. Kind of catapulted our apartment business. It was great. But let's talk about something. And this is a little bit more technical, but I think it's really important. Commercial real estate debt is usually what's called call protected. So year 1, year 10. This was a 10-year loan, right? This loan matured in March of 2028, and it's what's called call protected. Does that ring a bell? Call protected debt, where you can't pay it off. Like your home mortgage, you can pay it off whenever you want. Commercial real estate debt, you cannot pay it off, or it's a significant penalty if you pay it off. It's call protected. And the reason for that is if it's a bank, they just are managing their balance sheet. If it's a CMBS loan, recall there's bonds behind there. 10-year bond needs to be out there for 10 years. If you pay off the loan, the bondholders aren't happy. So you do something which is called defeasance. You ever heard that a defeasance? A defeasance is a substitution of collateral. So when this loan, we borrowed $30 million. I think we borrowed this from, might have been Key Bank, I don't remember. We borrowed $30 million, and their security was this apartment building. A defeasance is they gave us back the building, and we give them a basket of U.S. treasuries, asset for asset, but it's real estate for treasuries. It's just assets. You give me back the real estate, I give you treasuries. Well, the treasuries were very expensive. For this $30 million loan, we had to buy $36 million in treasuries. It cost us almost $7 million, a 22-point penalty to get out of this loan. So you say to yourself, why would you ever give the lender just, like in real estate deals, there's friction costs. You got to pay a lawyer. You got to pay, a broker. That's an expensive cost. 22 points. Why would you do it? Because it cost us $6.8 million to get out of the loan, but we made $25 million on the equity. Cost of doing business. So Norterra Canyon, that was my first apartment deal, 2018.
What was the sell signal? Why did you decide to sell in 2021?
Because our Newmark broker in Vegas, Doug Schuster, said, I can get you $86 million.
And that was, what was your initial thesis going in? What was your exit? Did it exceed that?
We always underwrite 10 years, just because that's what we do on a 10-year loan, but we always plan to hold most of our stuff around 5. So we sold this in 3 instead of 5 years. Because prices shot through the roof.
Was there any temptation to refinance at 3% versus 7%?
It's a great question, but for these investors, they're not long-term investors, they're shorter-term investors. So our deal with these investors is we're going to give you your money back, and you can decide to do it again if you want. So, that's how we raise this money. No, you can defease and refi if you want, but it's going to you still have to pay that $6 million penalty. So what you'll do in this instance is, if you're going to refinance this loan, you have to refinance it for at least $37 million, or you wouldn't do it. So let's go to the next one. This was our first deal in Dallas. So if you're familiar with Dallas, Dallas is just a huge market. And Fort Worth is off to the left here. So this is in northeastern, Dallas, up by Plano. That area is what's called the telecom corridor, AT&T, Lucent, a very dense job market up there. We've invested here, I think we own in this area almost 1,000 units. We love this area. This was new construction. We bought this in 2019. The property was built in 2017. We bought it from the developer, brand new, shiny car, had that new car smell. It was great. Our business plan here was there was no renovations. It was just push rents. Push rents and own a great asset. We paid $75 million for this property in October of 2019. That was a 4.90 cap rate. So notice here, a year we were at 5. This is an older property. Norterra is not as nice as Hendry, but we paid a 5.63 cap. A year later, now we're sub 5. So we're starting to push, a little more aggressive. But we're in Dallas, high growth, brand new car smell. Great asset. Almost 4 years later, we got a $100 million offer, which we hit. So we sold this thing at almost the same cap rate. Notice here, 4.90 cap, and we sold it at a 5 cap. So about the same. Bought it for $188,000 a door. We sold it for $250,000 a door. So how did we make money? Because we pushed the rents. When we bought this thing, the cash flow was $3.7 million, and our property management team, our asset managers, some of us earlier talked about asset managers, they're the heroes in owning real estate. They just pushed rents, pushed. In a high growth market, 10% rent growth. We really elevated the cash flow, and we made also $25 million on this deal. But notice the debt on this one. Interest rates now are changing. We borrowed this money at 368. And given where now this is 2023, interest rates now are shooting up, remember? And I don't want to get too technical, but when rates rise, and we can talk about it separately, it's a little technical, but when rates rise, defeasance costs fall. And so there is a theoretical reason is the wrong word. There's a theoretical situation where you can get out of a loan for less than par. You borrow $100, but you can pay it off for $99, based on the shape of the interest rate curve. That's exactly what we did here. So why did we sell? We generated a $25 million profit, but we paid off our $45 million loan, almost $46 million, for $45.2. So we paid this loan off at 99 cents on the dollar. And this was our highest return so far. We own this property, new construction, very low risk. This generated a 15% return for our investors.
You said that you usually underwrite a bit more conservatively.
Mm-hmm.
So how did you decide to put on like a 10% program projection going in?
No. On this one we underwrote 3 or 4, but we got 10. We pushed. We got lucky. The market just moved in our favor. So this was a great deal. This is a beautiful asset. I'm actually a little bummed we sold this one. I mean, as I like to say, we love all of our children equally, but this was a good one. All right, so how about a busted deal? So this is New York City, apartment building up by the United Nations on the Upper East Side, if you're familiar with New York, Upper East Side. This was a busted loan. We looked at this deal. We were going to be, this LP piece, we were going to be $18 million. The GP, they were going to put in $2 million. This is an existing Cantor Fitzgerald client. So they called us looking for $18 million. We got really close on this one. Didn't do it, but we got very close. This was an $81 million loan where, again, think back to my original thesis, or my point to you is, ignore the numbers. What happened? In every deal, there's someone who wins and someone who loses. So what happened? This bank made an $81 million loan because the business model was to convert this into a hotel. And so they underwrote the hotel as a hotel, not as an apartment building. Hotels can generate more money. So they were comfortable with a $81 million loan. They sold this loan for $45. The bank collected they lost 44 cents on the dollar. This was a huge loss. This was a $30 million loss for the lender. Forget about the equity. That was long gone. The lender took a $30 million loss. We were going to come in and buy the loan. So we were going to buy it for $45 million, the $81 million loan for 45, and then get what's called bridge financing to generate a 20% return. The reason we didn't do this deal is at the last minute, typical New York City real estate, somebody swooped in and paid more. And our partner got outbid. So, interesting deal. I still go by this property sometimes and think, was it the one that got away? I don't know. This is one we're working on today. This is live. If we wanted to pass the hat, we need $5 million. We could pass the hat and do this one right now. This deal is available if we want it. This is an apartment building. You can see how nice it is up in Jacksonville. Good looking property, newer construction. We know the borrower, the owner, is an existing Cantor Fitzgerald client. Not just one private jet, but two, but put that aside. So this is a guy that has a lot of money. He's well capitalized, knows what he's doing. He has a partner that wants out. Happens all the time. So the partner wants out, but here's why he won't refinance to get the partner out or sell. He has a $40 million loan at a 3% rate. Why would you ever give that up? You keep it. You keep it it matures in 2029. It's 5 more years. So he does not want to refinance. He just needs a little piece. He needs $5 million to replace his partner with somebody else. And he had an offer at 12% for that money, which he thought was too expensive. He offered it to us for 10 plus. So this is live. We may do this one. $5 million of what's called preferred equity. And if you think about the risk profile of this, this property is worth $60 million at a 548 cap rate. That feels okay. And we would be taking the position from 65% of the stack to 73, so that that little sliver right in the middle at a 10% rate. So pref is always just a negotiation. I think we would own, this piece would probably be outstanding for 3 to 5 years. Because how would he get out of it when this loan matures? So this loan matures, 5 years from now? That's how we would get paid off. So this one's available if we want to pass the hat. All right, 3 more, and then we'll wrap up. So CMBS deals, these are real deals. This is a live CMBS deal. This deal is in the market. Let's talk about some bigger numbers. So this is a shopping center in, I think this one is in Iowa, I forget, but what's that? Des Moines. Oh, Des Moines, yeah, this is in Des Moines. Anyone been to Des Moines? I've been there many times. Des Moines is great. I think Iowa gets a bad rap, but Des Moines is good. So this is probably the nicest shopping center in Des Moines. This was a refinance that Barclays did, so it's a refi. But again, forget about the numbers. I really want to emphasize that. Forget it. What happened here? Why did Barclays give this person $51 million? Because they had a loan that was due. So they had a $173 million loan that needed to be refinanced, and they gave the borrower $170. So this is a cash in refi. So in order to get a fresh 5-year loan, this owner had to put up $8.7 million to get the new loan. Cash in. And look at the interest rate, 7%. And then the cap rate on this deal, how did the lender value this? A 764 cap. So you say to yourself, is this lender protected? It feels like a good loan to me. We do buy CMBS. We would buy these bonds. We're probably looking at them. So I thought this was a good one. Here's another one. This is a hotel in Tampa. $35 million loan. Look at the interest rate. 8.49%. This one was done by CRE. Who is that? Some smaller debt fund. 25 million. But look, why is the interest rate so high? Again, forget the numbers. Think about the psychology. This person was asking for a cash out refi, taking money out of the deal, putting the lender more at risk. More risk, higher interest rate. 8.5% interest rate. They refinanced their $24 million loan for $35. They put $9 million in their pocket for the Porsches and the jets and the beach houses, whatever they do with it. we may be looking at the underlying bonds. Probably not the BPs, probably a few layers above.
Is it, it's only 35 million, is that?
But this is one of the loans that's in the deal. Yeah. And then one more. Office. So everyone talks about office is scary. Office is scary. This is an office in Phoenix, Papago, which is Scottsdale. Good golf out here. Nice looking office building. Look at the cap rate. $73 million building is a 760 cap. The lender, low leverage loan, only a 46% loan. $33 million loan. They got 34, but the lender required a bunch of reserves such that the borrower had to put cash in. Again, another cash in refi, $4 million to bump out their extension 5 years, their duration, excuse me. Look at the interest rate. I didn't circle it. Oh, I meant to. That red circle is supposed to be lower. 8.248%, 8.25% interest rate. But if you want to own the building, negative leverage, remember? The cap rate is what up there? The cap rate is 760. The interest rate's higher than the cap rate. The lender is making more money than the equity. But you do it because you want to own the building. And you hope in 5 years from now, interest rates are lower and you refinance. So that's all I had on deals. Any questions? And let's talk jobs. Let's get you guys in the market. Hopefully that was helpful. I like talking about real deals. Those are all live. So enough about me. Enough, again, of me talking. Why don't I take a breath? What are your questions about the job market? I mean, we're, at Cantor Fitzgerald, we do hire some people fresh out of school. Not that you guys are undergrads, obviously you're not, but we tend to hire more experienced hires. But of course, I know lots of people who are hiring right out of school. So I have a really good finger on what's going on in the job market. Happy to answer any questions and would love your feedback, yes.
What would you do if you were them? Like what field are you looking at? What category? How would you, when you're in the interview, what would you say? What's the aura you're putting out? Like, how do you get chosen?
How do you get chosen? And this question was asked earlier in a smaller group. When you're sitting across from someone who can hire you, be smart. I know it sounds oversimplified. Tell them that you think. Everyone at this level can run a spreadsheet. Just tell them you know how to think about risk, about risk-adjusted returns. Tell them that you understand the difference between positive leverage and negative leverage. Just be thoughtful. Talk about, hey, you know what? I can run the spreadsheet, but at the same time, I can also say no. I can challenge in a respectful way, my bosses. I've done that. I love it when our junior staff challenges us because, again, if everyone says yes, you have groupthink, you can really make big mistakes. And so, again, it sounds oversimplistic, but I would just make sure you tell the person you're sitting in front of that obviously you're a hard worker, but you love thinking. You think through deals. We have obviously accounting firms that do a lot of work for us. And something came across my desk 2 weeks ago. And it came from a name you would know. I won't say the name because it's a name you would know. From an accounting firm, an auditor. And it came across my desk and I looked at it. It was a deal I did. And I said, that rent just doesn't look right in the debt service. Something is wrong. And my accounting person said, the accountants reviewed it. Aaron, you must be wrong. And I was like, do me a favor, just check it again. I actually got the email yesterday. Our accounting firm is wrong. You have to challenge things. By the way, no one did anything. It wasn't malicious. They made a mistake. It was probably some junior person, middle of the night, with pizza in front of them, and they made a mistake. So I would just say challenge, and I would also say, at this point in your careers, don't just chase the last dollar. Don't go to the job that you want the extra $5,000 or whatever they're offering you. Take the right job. Now is when you can take some risks. You can be a little bit more aggressive and entrepreneurial. Find a mentor. Get someone and force that person to teach you. I tell my junior team, I said, if you're not asking questions, we need to find somebody else because you're not learning. I feel, and it sounds cliche, but I feel it's really important to me to mentor people. And that's one of the reasons why I'm privileged to be in front of you. Hopefully you've learned something from this. And I take a lot out of this because I want you to succeed. I want you to send me deals. No. I think mentorship is so important, and like I said, it sounds oversimplistic. Just get in the room, go to the dinner, go to the cocktail hour, get in the room.
You talked a little bit about risk-adjusted returns. As this group comes out, what do you think, in terms of the market as a whole, is the number one opportunity? I hear like the debt side's great because you kind of get an equity-like returns for debt funds, but like longer term, next 5 years, if you're positioning yourself coming out right now, would it be debt, equity?
I think it's a great time to be a lender. Again, if you have fresh capital, you're not dealing with problems like a fresh fund, it's a great time to be a lender. It's a crowded space, so I think you have to be, if you want to be on the principal side, you have to be, I would suggest, being in a firm that can be flexible. You can go after first mortgages, mezz, pref, what have you. All of it's debt to a degree, unless it's the common equity. I think there's a lot of opportunity there. And I'll tell you something else. Everyone coming out wants to work on Wall Street, right? They want to be a banker. They want to be on the principal side, whether it's debt or equity. There's a lot of great real estate careers that aren't maybe so front and center. You know what I mean? Like asset management is the one that really comes to mind. Asset managers right now are the heroes in our office and in our partners. They're the ones who are carrying these things like their children every day, these loans or these properties, and squeezing every dollar out of them. The asset managers are the heroes, and you can have a long, very successful career as an asset manager. You may not be thinking about that. Banks have great asset management departments. Every debt fund has an asset management department. I have asset managers. And I just think I wouldn't overlook that. Don't always try and chase, the flashy job, right? The banking job or the acquisitions job. Those are very volatile. When you're committing capital, you can get fired pretty quick if the deal goes bad. But you can have a long, very successful career as an asset manager or a property manager or just closer to the bricks and the sticks. And I would encourage you to consider that. Or consulting.
I've heard a lot of people talk about how being in New York, you're being close to the money. That's where the deals happen, that's where the big companies are, that's where you'll make those network connections, those things like that. For people trying to break in, what's the best thing to do for them? And then also for people that aren't going to be in New York, is it better to start your career out there and then spread out? Or is going to one of these cities like in Atlanta or in Miami, do you still get that same kind of repetition and clientele and networking that you would in New York?
It's a great question. We debated this at length earlier in a smaller group. New York's fantastic, but it's not for everyone. And if you have the right opportunity with someone that's going to mentor you and a group that you feel comfortable with, that you can learn and grow at least for a handful of years, you don't have to be there forever, you don't have to be in New York. Because you'll get access to folks like me and our team, because we're coming to you. If you have a deal, we come to you. And as you grow your real estate careers, you'll always make your way to New York. You may not live there, but you're going to spend a lot of time there. And so if you find the right opportunity, Miami, Atlanta, Nashville, Tampa, Raymond James is in Tampa. They have a great real estate investment banking program. They're a company we talk to. I would take the right job. I wouldn't be fixated on New York. That said, it is the financial capital of the world. So if you want to be there, if you want to ride the subway, if you want to step over, bums or old pizza on the sidewalk and deal with that, it's cold. I don't like the cold. 22 winters and I still don't like it. New York's a great place. What else?
You said to take the right job over, just whatever kind of comes along, but I think a lot of us are in the kind of mindset of, hey, we're going to take whatever's, coming, just at least in this market. So for those people that are kind of taking a job that they might not necessarily have planned to take, do you think that someone is necessarily kind of pigeonholed, or do you think that eventually,
No, it's not
another career they can kind of transition to what they really want to do?
Yeah, it's not a prison sentence, right? You don't owe them 20 years.
Yeah.
Look, first and foremost, you guys got to get out of work, right? So you got to take a job. But if you're taking your second choice because that's just the way the chips fell,
the way the market is.
Because it's a tough market right now, don't be discouraged. Stay there for a couple of years. The market's going to get better, and then just talk to people, network. And then that person you're talking to may hire you when the market gets better. And so I would take a job. Don't be on your parents' dime forever. Take a job, but don't be discouraged if it's your second choice. Just get in the market, start learning.
You invested in any kind of deals on your personal time, or is it all real estate work focused, and when you go home, you turn off?
Yeah, no, I do my own deals. I'm a real estate guy, and so I like doing my own stuff as well.
Residential, commercial?
Residential.
Okay.
I love apartments. I want to have my own portfolio and give it to my daughter one day. That's my goal. Hope she appreciates it. She keeps talking about a beach house. I tell her.
I know you're probably biased towards the principal side, but there's two sides. So there's the debt, the equity.
Yeah.
What should we be looking at? And for transition-wise, going from equity to debt or debt to equity later on in our careers, what would that kind of look like?
I started on the debt side. It's a much bigger market. The debt markets are huge. And I think it's really important to understand just the debt because you're in the middle. You have to look at what your borrower, right? As a lender, you have to look at your borrower. What are their motivations? How do deals go great? How do deals go bad? But you have the protection of not losing your job because you're hopefully in a more secure position. You'll understand the loan documents. What is a mortgage? How do you analyze collateral? You know what I mean? I started on the debt side. I feel it was the right move for me, and then I went to the equity side, because I think I'm a much better borrower now than I was a lender. Lenders don't want to hear that, but I know exactly how lenders make money, and I know exactly the questions to ask to negotiate in my favor. And if I didn't start as a lender, I wouldn't know what makes them tick. And by the way, I'm not just trying to reach into their pocket. I know what's important to lenders. And so I can give them something which is important to them, but at the same time benefiting myself. And so I prefer starting with that side. And it's a giant market. Like a mortgage broker. That's a great place to start a career as a mortgage broker.
Yes. Can you elaborate on that a little bit more, like the unique positioning that you have, the unique experience from each side? Now you kind of be on both sides.
Yeah, I think the real estate business, like I said, is a levered equity business. It really runs on debt. There's very few all-cash deals. The real estate is a debt, and by the way, by design, it is a good thing. And I just want to emphasize one point before I forget. This is a debt business. And you have to understand debt to maximize equity returns. And so again, I think the best private equity people I know were lenders first. You can get a private equity job right out of school and learn it that way. But the way I did it, and the way others I know who have been very successful, they started on the debt side. Again, for that reason, because think about it. In this example, this $100 deal, 70% of it is debt. So you want to make sure you really understand the biggest piece. Just checking my notes to make sure I don't forget anything. Pizza, we don't talk about that. No, there's one thing I want to talk about, just a closing point, and I'll say as long as you want. Again, I feel very fortunate to be in front of you, so again, thank you. One last thing on debt. Again, psychology. There's two types of debt. There's what's called recourse debt and non-recourse debt. Does that ring a bell? I see 10 nods. And again, my lender friend in the back's not going to want to hear this, but recourse debt means it's personal to the borrower. Where, back to my very simple example, if you borrow $70 and the property value gets cut in half and it's only worth $50 for whatever reason, now you don't have enough to cover your loan. See my point? You don't have enough to cover your loan. If the loan was recourse, which means it's personal, the lender in this case is taking potentially a $20 loss. How can they get that $20 back? They go after the Porsches and the beach houses. They go after you personally. The commercial real estate market is, for all intents and purposes, a non-recourse market, and that's by design. If I'm spelled that right. It's a non-recourse market, meaning in this case, the lender cannot come after you. If you default on this loan, they can only just get what they get from the property. Now, you'll never borrow another dollar from that lender. Your reputation will be shot. And again, reputation is critical in this business. Now, and again, I emphasized that to some of you earlier. Your reputation will be shot because all lenders talk to each other. And if Aaron Wessner created a loss for a bank, all those guys play golf with each other. They all know it's going to be very hard for me to get a loan. Your reputation is everything. But technically speaking, they can't go after your home or your personal assets. And so it's just an important point to where that helps folks like me and others sleep at night in the sense that when you're borrowing huge sums of money, you only have at risk your equity. You don't have at risk your equity plus your family's home, unless you sign personally. And some people do because they need the money. I think that's all I had, and we went a little over, but I think it was a good discussion. I hope it was a good discussion.